Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Awesome. Well, welcome everyone to this month's edition of our AWA Market Minute. This is always something that we look forward to doing, being together with our clients and walking them through current and relevant topics that impact their retirement. To kick this off, I want to start off first with a housekeeping item. Please note that everything we talk about in these calls is designed for a broad audience and intended to be more general information in nature. We don't want anyone to take this information and act on it without first having come in and talk to us on a consultative basis where we can give you real advice one-on-one for your situation. So this is more intended to be entertainment purposes. With that, I want to entertain. So let's wrap up here. I want to show you guys a quick story of just 2 weeks ago. This was me and my family hiking to this beautiful landmark down in Arches National Park. This is called Delicate Arch. And it just so happens to be one of the most iconic landmarks, I would think, even outside of Utah, maybe perhaps in our country. It's got travelers from around the world coming to this beautiful Delicate Arch. It's on our license plates here in the state of Utah as well. So those who have made this trek down in Arches National Park and hiked to this, they know that the last 100 yards leading up to this landmark, you're actually hiking around a cliff. And on the right-hand side, there's a pretty steep, tall cliff wall. And on the left-hand side, there's a pretty steep cliff drop. And in between, there's this nice little carved out ledge that serves as a bit of a passageway or sidewalk, so to speak, to get you about 100 yards around this big, cliff outcropping until landscape arch kind of pops into view. So we're hiking this with my 4 kids and my wife and I. And my youngest child, Connor, who's 7, partway up the hike, got really anxious, really nervous. And he kept saying, he kind of was moving kind of funny. And he kept looking at me and saying, "Dad, my head feels dizzy and my feet don't work." And I kept saying, "I'm not sure, why your head feels so dizzy and your feet don't work, Connor, but you got to look forward." And this happened a couple times. And he was more and more anxious about it. And so I finally stopped and knelt down beside him. And I said, "Connor, you're looking and fixating over to our left here at this cliff ledge. And that's all you're looking at. And that's all you're seeing is this cliff ledge on the left. And I think because that's all you're looking at and that's all you're seeing, you're focused very heavily on the fear of falling." And I said, "Instead of looking over there, why don't you look straight ahead of you, down a little bit, just in front of your feet, where you can see the safe passageway that's going to get us very safely to our next destination. If you just look down a little bit and just in front of your feet, a couple of steps ahead of you, you're going to make your way to this beautiful arch and we're going to be safe and we're going to enjoy it together." So he did. He started looking down a little bit just in front of his feet and made his way around this ledge. And sure enough, we got to enjoy this beautiful scenery of landscape arch. And that got me thinking a lot about kind of the emotions behind investing and specifically the emotions around very volatile markets. And I think sometimes as advisors, Scott, people think, well, they're making recommendations that are naive because they're not willing to acknowledge the danger of this cliff ledge. And I want to make sure that we acknowledge that there are things out there when it comes to investing that are real dangers. They exist. We're not trying to paint this overly optimistic picture of an investment landscape that says there's just no way that anybody could ever get hurt out there. And Connor, my 7-year-old's emotional response to the ledge was not baseless.
Right.
It wasn't baseless, and we want to have empathy for that. It wasn't baseless. It became, the more he stared at it, however, increasingly irrational.
Right. It's all about perspective.
Perspective.
Yeah.
And so as we look at perspective, this is a picture, by the way, of me and my son, Ty, the 12-year-old, as we got to the arch. We actually hiked right up underneath it. It's kind of a cool moment together. But so I think when it comes to perspective, and Scott, I like that word, sometimes we look at this and we worry, okay, we're only going to stare at, this area that is obviously safe. And that feels naive.
Yep.
Feels naive. And it's because it is naive. And then others stare only at the area that says there's obviously danger here and we're obviously all going to die.
Right. Right.
And that feels irrational.
Yep. Yep.
And so our job today is not to be irrational or naive, but to have perspective. To have perspective that, okay, there are real things that we need to discuss and be aware of so that we can navigate around them safely. And then there's also a very clear pathway forward. And we need to be aware of how to navigate that clear pathway forward safely so that we can see the end result, right? Carl Richards is, a brilliant, cartoonist who talks about financial issues. And he drew this up recently. He said, which do you want to focus on, today or the big picture? And to try to bring this all home, this would be something that we deal with almost on a daily basis, it seems like, for the last several months, right? Something like this is almost on a daily basis. And we're not naive to this.
Right. Right.
We're not naive to this. This is a real thing that we have to have a real awareness to the threat and the danger of what's out there. But simultaneously, we want to maintain perspective, right? That's very important as we talk through investing, especially long-term retirement planning, that we have a proper, appropriate perspective. So with all of that, Andrew, will you kill that slideshow for me? We want to introduce to you today our guest speaker, and he's backed by popular demand. This is Kurt Brown. He is the Chief Investment Officer for a multi-billion-dollar investment platform. Kurt Brown is widely recognized as a strategist for economies. He's been in the capital markets for multi-decades now, started his career literally trading on the floor of the New York Stock Exchange, and has done everything from that to managing large funds. And we really value and appreciate Kurt and his perspective on capital markets, on economies, on politics, and how to kind of bring all this together with some great data and information. And so today we want to talk through both the appropriate perspective on the cliff ledge and the appropriate understanding of how to get past this emotionally by looking ahead at a clear path forward.
Hey, that's one of the best, that's one of the kindest, best intros I've ever had, man. I did not too long ago. I walked through the door at the end of work, and I have young children at home. And I said, as I walked through the door, backed by popular demand, and my wife looked at me and just rolled her eyes and said, "That's ridiculous. Shut up." So I've never been back anywhere by popular demand. So that's great news. I don't know who, but no, thanks for having me in, man. This is an I was teasing this week. I was speaking at a conference in Los Angeles on Monday, and I was teasing. I was like, "Hey, something going on in the markets, the stock and bond markets? They seem boring to me. I don't know what's going on."
No, it's all pretty vanilla nowadays.
It's been, it's funny because I'm celebrating my 30th year of working on Wall Street. I turned 51 recently, and I was adding up in my journal recently, Paul. This was the 23rd market correction that I've worked through of 10% drop in the stock market or more.
Yeah.
And it's my 8th of 20% or more, and I was going back and sort of reminiscing about some of those memories, especially early in my career. And I decided what I would do is add up what has the market done since 1991. So I found the day that I started, and the market is up right about 2,300%, about 23 times.
Yeah.
And you think about that, I've been through 23 10% drops, but the market's up 23 times what it was when I started my career, and I was thinking through those, and every single one of those 23 market drops has been stressful. It doesn't,
and it feels like all you can see is the cliff.
I know. I'm listening to your story, and I'm like, I get it. I told a story not too long ago about a buddy of mine that's in the Navy SEALs, and the way that they get those guys through that hell week where they don't let them sleep for a week is they actually teach them to only focus on the very next thing in front of them.
Yeah.
And that will help you overcome the emotion, because when you try to absorb everything at once, it's actually almost too overwhelming for your senses. You
It's
can't
paralyzing.
know.
Yeah.
Yeah, that's right, Scott. Like, it's paralyzing, and that's why what we'll talk about in the next couple minutes is of course, we want to understand what's going on, but in terms of action, we have to build portfolios and retirement plans that are prepared for this kind of thing.
Yeah.
Because the average for 100 years is that the stock market drops at some point in the year 14% during the year. That's the average. So we have to have portfolios that are built for these averages, right? And yet, to your point, Paul, it always feels like the end of the world. And the pros feel the same way. So should we dive in and go through some of these?
Let's dive in.
Okay. All right. Let me see if I can share my screen here. In the world of Zoom that we're in, can you see that okay?
Yeah, you're not in presentation mode, but yeah, we can see there you go.
How about that? We're looking good?
Perfect.
Okay. So bottom line is, as bad as things feel because of inflation and gas prices and a host of other things, the truth is the economy is unbelievable. Remember, we're in the spot that we're in because the economy has been exceptional. That's actually why we have the problem we have. And then we printed way too much money and dumped it on top of an exceptional economy. That leads to inflation for the first time in 40 years. And what you see on the screen is the problem. The Federal Reserve can not allow 8, 9, 10% inflation to continue. It would cause way worse problems than raising interest rates and slowing the economy down, which is exactly what we're going to right now. One of the reasons it feels painful to us is that this is one of the worst year ever for both stocks and bonds. So if you have a good old-fashioned 60-40 portfolio with 60% stocks and 40% bonds, you're actually having the worst year since 1931. I mean, that's rare air, right? That's, so there really hasn't been any place to hide. Long bonds, 20 and 30-year US government treasuries, they're down more in the past 12 months than the biggest 100 tech stocks. So that'll put into perspective how volatile treasuries have been, trying to get their head around where does inflation end and how much damage will the Fed have to inflict to slow that inflation down, right? That's really the issue. Okay, so there's only been 2 other times in the 30 years I've been in this business where we are cheering for the economy to slow. It feels weird. It's counterintuitive. But the truth of the matter is I'm cheering right now because the economy is slowing down. It got crazy. You couldn't hire anybody. You couldn't buy anything. No one can afford a house. I can't even buy a new car if I want to buy a new car. Remember what we've gone through the past 2 years? It's ridiculous. That is not sustainable. We need a more healthy sort of 2-directional market. So I'm going to rip through a couple slides really fast here because I want everybody to see that even though the 1-year inflation data is high, the 2 and 3 month inflation data is not. And it's changing very, very quickly. Okay, so here's new orders rolling over. Here's what manufacturers are seeing in their pipeline and their sales pipeline rolling over. Durable goods. Here's your washers and dryers and washing and dishwashers and ovens and all that. Big ticket items rolling over hard, more than 2008. That's how fast that market is slowing down right now. Real spending has not done this since 2008. It didn't even do this during COVID. So you and I and the rest of America is spending less money in the last 90 days than we were spending. We are being more responsible with what we're doing, which is cooling down the economy. It's exactly what it's supposed to do. Remember all these commodities that at the first part of this year were just exploding through the roof. Remember lumber up here at $1,500 per, right? Okay, look what's happening. All of these commodities and all of these inputs and materials are starting to roll over really fast right now. This is just the last month right here. You can see the upper right-hand corner there. So the 1-year data still showed a fair amount of inflation, but what's happening right now in real time is a slowdown. 7 out of 8 months, used car prices down and down pretty sharply. Remember, used cars were a major problem in that COVID era. It was really hard to get your hands on a car. How about new home sales? Look at this. I mean, look at that. We have, I mean, falling off a cliff, right? Here's existing home sales. 26-year low in mortgage applications being submitted right now for people to want to get a new mortgage. This is what happens, of course, when mortgage rates go from 2.6 to 6.6 in 6 months, right?
Kurt,
Yeah.
so just interjecting here, I just want to make sure that there's not a disconnect with the clients in the call as you're going through this information. You're saying it with this like, hey, this is great information. And some people might hear all this and say, it sounds a lot like you're telling me everything's getting worse.
Yep.
Please help them make the connection of this, how this is making things better.
So, and I'm glad you said that, because I really am excited that the economy is slowing down right now. And it really is the bizarro world. We never feel this way. But what happened was, we need the economy to go from red hot to just growing nicely again. That's what we need. I'm going to show you another chart in a second. Our companies started minting money and growing earnings at a pace that's just absolutely not sustainable. It's making the cost of everything going up. And the truth is, it's hurting the people in this country who are the people that cannot afford it. The people that get hurt the most are the lower income people. They cannot afford for this to happen, right? So you're exactly right, Paul. If we can get the economy to cool, the Fed will stop raising interest rates. We can get inflation tame again and get more normalized markets. We can actually get houses to come down a little bit in price, so we can get some people that can afford them again, get people selling things again. I can go buy a used car again and things like that.
Yeah.
It's a
Kurt,
great. Yeah.
I'm going to interject as well on this point, because I'm going to channel some of the questions and sentiments that I hear from some of our clients. And some folks are concerned this feels like 2008 again. We're having kind of crazy news in the credit markets. We're seeing a big slowdown in real estate. Talk through how this is dissimilar from the 08 financial crisis.
I'm so glad you brought that up. And I do have a couple slides coming up, but I'll tease them now on this. It's completely different. I mean, it is so apples and oranges from 2008. Let's take housing, for example. I hear people right now all the time say the housing bubble is popping. There has not been a housing bubble. A bubble is not just prices going up. Okay, the reason that 07, 08 was a housing bubble was that you had a massive amount of buying on absolute garbage fundamentals, right? You had people borrowing money that should have never been able to borrow money. Massive amounts of the market was subprime. And that's what was leading up the market. Okay, I don't have the charts in this particular presentation, but what led this housing rally the last couple of years was all cash, highest FICO scores you can have. That was the big buyer in the market, was the high quality FICO scores, right? And a real reduction of supply. After the financial crisis, we didn't build homes in this country for a decade. And then all of a sudden, everybody wanted a home coming out of COVID. Interest rates are super low. So you're getting a free mortgage, right? 2.5% mortgage. So you have everyone trying to buy a house at the same time, and you don't have enough supply. So prices move up. But that does not mean that the foundation is sandy. The foundation of the housing market is so much better than it was in 08. The second big culprit in 08, Scott, was the banking system. The banking system is 180 degrees from where it was in 07, 08. They are so liquefied and so strong, these bank balance sheets, that they don't want your money. In fact, the 1-year treasury goes to 3%, but what's your bank paying you in your checking account?
Yeah, quarter
Zero.
percent. Yeah,
So
zero.
they don't want your money. And I'm going to show you a chart in a second that shows you how much money banks are sitting on. So yeah, completely different than 2008. This has been the largest decline in housing prices ever in a 60-day window. Now, that's relative. They had gone straight up. So of course you're going to get some retraction in housing prices, right? This is the cost to ship a container from China to Los Angeles. Look at this, down 57% in a year. So you tell me, is an economy that's overheating doesn't have container prices tanking, right? So the Christmas is probably going to be a little slower than people originally anticipated. Here's another one. This is the data right here that the Federal Reserve looks at, right? This is manufacturing input prices here in the United States. They are rolling over hard. Well, historically, that travels in tandem with headline inflation. So this line is going to have to come back down. I mean, literally the math that goes into inflation is rolling over. Let me show you this one. Here's food in the inflation data with the Federal Reserve, like CPI, right? That's our inflation. Okay. But the stuff that goes into making the food is all rolling over really hard in the last several weeks. So you're going to see food prices moderate at the grocery store because everything that goes into them is moderating, right? So there's certainly some stickiness to it, but you can see how correlated historically these lines travel with each other. Okay, so as of last Friday night when I put this together, okay, the stock market made a new low on Friday afternoon of last week. And these 6 readings, technical readings, are from Thursday and Friday of last week, okay? And they will show you, and I'm not going to go through each one in depth here, but they're going to show you really extreme negative, pessimistic, and selling inside of the US stock market, right? Some really extreme things. Like 3 times in 20 years that's happened, right? That like very rare kinds of readings. But the thing that I want to point out to you about this that's so interesting is every one of those are hallmarks of market bottoms. This is not what you see at market tops. This is what you see at market bottoms. And I'm not saying last Friday was the bottom. I have no idea and nobody knows because in the short term, animal spirits reign. But the point is that we are getting into really rare air with how pessimistic and negative the market itself has been. And by the way, I'm showing you the stocks because we all speak this language all the time. I can show you a list just like this for US treasuries and bonds. Looks the same exact way. All this really shows is anytime you get a really nasty bear market, a real drop of 20, 30% in the stock market, there's a list of things that we tend to check off before we know we're at the bottom. And in the January sell-off this year, we didn't see a lot of them. Market bounced a little bit, same in March. We're really starting to see a lot of those boxes get checked now. A lot of things are being checked off the list. It would be nice, you know, the trader in me, the contrarian in me would like to see some people just absolutely panic and give up and get rid of everything they own in their lives. By the way, don't do that. That's irresponsible. But when
let other people do that, right?
You don't do it, right?
Yeah,
but when we see that, that's usually when you want to be in there buying assets with both hands, right, Paul?
And yeah, and I think I want to even clarify that further. Like that's an indicator when we see that capitulation, that exhaustion, where people are just like, I'm done. That generally so maybe I don't know that everybody appreciates this list. This is a list you've created over the years that says this is a list that when we check all the boxes, we can point to a really close. This is where the market's bottoming.
Yeah.
Right. Yeah. And so that's generally one of those indicators where it's like, hey, when there's just general, sentiment of I give up, uncle, I'm crying uncle. That's one of those check boxes. And here you've said no, and I don't know if no is totally fair or some where that lands on the list. I think people are smarter today than they were 20 years ago about saying I'm not willing to entirely
panic,
sell everything. But we're seeing a lot of people saying, just tell me when it's over. I'm going to be over here fishing. There
is one major difference between today's market and every bear market in US history, 125 years of market history. Our economy and people's personal cash positions have never been as good as they are in a bear market as they are today.
Yeah.
Usually there's a correlation to a bad economy. Our economy is actually very good, and the average American has a fair amount of cash on hand. So that may be playing in, Paul, into people not panicking and dumping their investment programs. I will tell you, this next chart here is kind of interesting, and there's a lot of this data. I love this kind of data. I could show it to you all day long. I'll just cherry pick one. But any time that the S&P 500 has dropped 20% in 6 months, okay, since World War II, what has the market done, right? Now, this is not saying, you have to buy the bottom. This is just saying anytime the markets drop 20% in 6 months, here's what you do. Over the next 1 year, the market has averaged about a 31% return and is higher 100% of the time. And I'm not saying that's what's going to happen,
No.
but that has been the experience, has been you're getting to a very stretched level here where I'm much more interested in looking around for opportunity than I am for the door, you know?
Yeah, and the way I articulate this to clients, Kurt, is, or the dice increasingly are becoming more and more loaded for things to be up a year from now rather than not. And that's not a guarantee, but if we're looking at probabilities, boy, those probabilities are getting awfully high.
Absolutely. You know, I'll show you a few other things that nobody, you know, the media won't talk about because it's good news. The media kind of wants to feed you fear, so you watch, right? Is that corporate earnings actually continue to be phenomenal and they continue to grow. They're growing at a slower pace. But this is great news. I mean, okay, think about how hard it is to hire people. Think about how expensive everything got, and corporations are still finding ways to run efficiently, make money, make profits, etc. And this is the chart I referred to earlier. Look, this is the earnings of the S&P 500 companies. Okay, coming out of COVID, look at this. How is that sustainable? It is not sustainable, right? So when we do this now, everybody, you know, the pessimists will say, oh my gosh, it's an earnings recession. We're in a recession, to which I'm saying, we're not even back to trend yet. I mean, right, I mean, this is the trend line, right? So we really needed the cooling, but you can simultaneously cool and still have a very good economy. You'll hear this little term called a soft landing. People in our business love, you know, putting wrappers on things and naming them funny names, but that's all that means. That means that you can slow an economy down and not crash an economy. And we really believe that's exactly what's going on right now. I'll just show this quickly. This goes back 50 years. If you take US corporations and you take all of their debt and you compare it to the value of all of their equity, you're at 50-year lows in the amount of debt that US corporations are losing. But when you turn on the TV, what do they tell you? The United States has ballooned in its usage of debt. Well, guess what? Almost all of it is the federal government themselves.
Right.
They are the culprits, not the corporations and the households. Here's households. It's a little bit off the low. People are borrowing a little bit more right now. Things got a lot more expensive the last year. So there's a little bit more borrowing going on. We need to get that under control. But we're not even, the average American is not even back to where they were with their debt before COVID. We're still better than we were. But when you turn on the nightly news, you think, oh my gosh, the wheels are falling off the bus, you know? This is mind-blowing. Going into the financial crisis, we as Americans kept roughly $1 trillion in savings accounts. We've got 9 trillion right now sitting in checking and savings accounts. That's absolutely stunning, right? We got scared after the financial crisis, so we started keeping more money on hand. And then after COVID, of course, we're all hiding in a bunker, right? So households are not looking, like right now, you have hundreds of people on this call. How many of you right now are out borrowing every dollar you could find to borrow? None of you. 0 is the answer, because you all are more responsible than that, right? And look, the banks are the same way. Okay, so for every dollar that a bank takes in, right now they're only lending out 60 cents of it. Okay, what's that Christmas movie? It's a Wonderful Life, you know? Okay, yeah. So when we got to the peak of the financial crisis, banks were lending out 105 to 108% of what they were taking in. So Scott, going back to your earlier point, the banks are in the complete opposite world from where they were going into the financial crisis, right? We're back at 75-year lows. And by the way, again, this is why your banker will give you no money to put your cash at the bank, none. And I will put a little plug in. You actually, if you are sitting on cash, talk to the guys at the firm about what to do with that cash, because you can buy a very, very high grade liquid portfolio of bonds now and get 3 or 4% for just sitting on it. And you know, they're not giving that to you at the bank. So there are ideas and things that you can do right now.
Real quick, Kurt,
yeah.
While we're on the topic of bonds, I think this is a important conversation to have. You know, some folks have wondered aloud if bonds have had their day in the sun, you know, if the carnage we've seen in the bond market indicates that, hey, it's probably not a core part of your portfolio and it's going to have tough sledding for the foreseeable future. How would you respond to that sentiment?
You know, I have a guy that works here on our credit team who is running around on a daily basis now yelling in the hallways, bonds are back, baby, bonds are back. So let me put it to you this way. Right at this minute, as of today, you can buy a portfolio of Fortune 500 company bonds, A-rated or better, high-grade bonds, and get 5.5% interest on that basket of bonds. That has not happened in 14 years, 2008 is the last time that happened. If you want a little bit more risk and you are willing to do some middle grade bonds, triple B, double B, get down into that area, you can get yourself up around 7% for corporate bonds. High yield is at 10%. That's a little more aggressive type of paper. So I haven't seen opportunities like this, Scott. And 08, by the way, was not an opportunity because the world was coming to an end. So I haven't seen an opportunity like this in bonds in close to 20 years. It is a phenomenal opportunity. I personally, and I'm a risk taker by trade, but I haven't bought as many bonds as I bought in the past month in 20 years in my own account. And by the way, not to hide under a rock, because the risk reward is so exceptional right now. That's how much the bond market has changed in 4 quarters.
So I guess on that point, Kurt, how much of the future interest rate increases are priced into the bond market at present? Because I think some are fearful, hey, I go out and buy a bond, and with MVA, shortly thereafter, it's going to be down in value. How much of that's already embedded in bond prices, in your opinion?
In my opinion, all of it, because I believe the Fed is getting close to ending their rate hiking cycle. I think they're going to hike a little more between now and the end of the year. And then I think that the economy is slowing enough on its own that they can be done. Now, what will happen is the rates will go back down. Bonds will start drifting back up and rates will go back down. So I think there's a very interesting opportunity here to lock in some cash flow for several years on some of these bonds. You know, an annuity is another great way to do that, right? Where you have it's essentially the same kind of thing. You can put a floor underneath it. You can get tax benefits in that. And you're seeing opportunities in annuities we haven't seen in 20 years. I mean, we woke up and all of a sudden it's a new regime. We got so used to the fact that there was no interest rates anywhere anymore, but that's dramatically changed. People don't understand that's changed because their bank's not giving them any of the money. But the banks don't want the money. That's the point of the conversation. You're asking exactly the right question, Scott. It's a very interesting time right now. Yeah. Okay. There's a couple bargains showing up in growth assets again. Stocks were not cheap for a long time. Let me go back to this slide for just a second. If you take the big 10 out of the S&P 500, right? The darlings. Let's talk about the S&P 490 for a second. The rest of the S&P 500. This is after you get rid of Amazon and Google and Apple and Microsoft, right? The big boys. Okay. Look at how cheap the market is, right? The 20-year average or the 10-year average is here. The 20-year average is actually right around the same place. So those 490, you're starting to see some very interesting values in equities. We haven't seen it in a while. Now, look how expensive the market got, right? We're coming off some expensive periods. Here's another way of looking at it. Right now, on the whole U.S. stock exchange, 12% of companies, the value of all of their shares is less than the cash they have in the bank. So you could go in and buy a company and use the cash they have in the bank to pay yourself back. Okay, that didn't happen in 02 or in 08, right? So my point is there are problems in the market. I'm going to talk about that in a second, but there's actually a lot of opportunity now in the market as well. Even fund managers, okay? What you're looking at is when fund managers report taking less risk than normal. This is a giant monthly survey of stock fund managers in the United States, okay? And guess what? Newsflash, those guys get nervous too. So at the bottom in 08, they're reporting that they're not taking as much risk as they usually do. Well, they probably should have been taking more risk at that point, right? And we're having that phenomenon again right here. Here's another way of looking at this. This is consumer sentiment. As good as the economy is, you and me are taking surveys and telling people we feel like garbage. Our outlook on the economy is terrible. Now, don't get me started, because I actually think that's because our elected officials are complete train wrecks, number one. And I think the second thing is social media and the media is doing nothing but feeding us a daily diet of negativity, even where it is not warranted, right? Because this is the worst sentiment reading in 70 years of this survey, and the economy's not bad, right? So that'll tell you kind of how jacked up the survey work looks right now. Okay, my final prepared comments here are just some higher level things to maybe remember. One is you're looking at here, since World War II, you take the 500 biggest companies, and this is their earnings in red, and in blue are the stock prices of those same companies. And what's stunning about this is 75 years later, they're still almost correlated 1-to-1. So when you're investing, you really are buying the future earnings of what you're investing in. This is why you have to be so careful about what you're investing in. That's what you're buying in the future. The other thing is what we're seeing is the price of admission, right? Okay, so here's every bear market. Remember 1987? I'm wrapping up high school. I remember the stock market crashing. By this point, I'm really interested in the market. And we thought the world was ending in October of 87. And then the market went on to rally 582% before the next bear market, right? In 1980, I remember my parents locking in a mortgage because mortgage rates had gone from 18 to 15. And my mom insisted we lock the mortgage in at 15. That was a really scary time in US history. And then we had a bull market of 229%. So this is normal. And when you look at this, this is the risk premium we all pay to make money in the long term, right? One of the things that you might find interesting, and if you want the white paper around this topic, it's super fascinating, the studies around this. But in every single case, now this chart goes back to 1950. We've got the data back through the Great Depression, but every single recession, okay, the market peaked before we were officially in a recession, and the market bottomed before we were officially out of the recession. And the reason I'm bringing this up is this. If there's an investing mistake that I see people make all the time, is they'll call right now and say, why don't we do this? Why don't we go to the sidelines until the air is clear? And the problem is, when do you get back in? Because nobody rings a bell at the bottom, right? So now if you're going to wait for the data to end, you're going to miss a significant amount of the appreciation of the next bull market. And that's how this works, you know? And I could tell you several sad cautionary tales about people that got out and never got back in, because there's always scary stuff on the horizon, you know? So I said earlier, Scott, I said, control what you can control, right? You can pick what you invest in, right? So over the last year, these high profit margin businesses, MasterCard, Visa, Home Depot, good high profit margin businesses, they've been killed. They're down 20%. But you know what? That's normal. What's not normal is if you built a portfolio here and you're down 60% over a year, your retirement plan's not recovering, right? We can't afford this. And this is why the planning is so critical. We want to buy really high quality types of assets in your bonds, in your stocks, in your private investments that you make, right? There's a lot of these zombie companies that are still running around out there. These are companies that their balance sheets are not in very good shape. They borrowed a lot of money to survive. Guess what? Interest rates are going up. Economy's slowing down. What do you think's about to happen? Bankruptcies, failures and bankruptcies, okay? So be disciplined about what you buy, because even though the prospects for the economy are good, there's going to be a lot of companies that vaporize probably in this cycle.
And Kurt, I'm going to maybe interject, make a comment here too. This makes a great case for our clients who are on this call here. When we talk about the term smart investing, and we talk about, you know, utilizing the brightest investment selection committees in the world to do the research, due diligence, and analysis on these individual companies to make a determination on what is appropriate to own and why you should own it, and put that directly into your portfolio. This is how we can help protect from this exact problem of having a zombie company that might be littered inside of a larger index or mutual fund that you really don't have any visibility or transparency or control over, but it's part of that grouping. And in this situation, we have a tremendous amount of visibility, transparency, and intentionality around what our clients own and why they own it.
I love that.
And I look at it too, there was a phrase I heard early in my career, gremlins in the basement. And right now in those indexes, there's gremlins in the basement, right?
Yeah.
And right now, indexes really haven't been taken to the woodshed at all for having some of that garbage in them. At some point, stock picking and owning quality assets is going to pay handsomely. And I think we'll see that at some point in the future.
Just another fun anecdote here.
Yeah.
We were at a conference last week or 2 weeks ago, I guess. And one of, and I won't say names or anything, but one of the investment selection committees that we work closely with was there at this conference with us, and one of their head portfolio managers sat down with Scott and myself, and we've got clients who utilize this group, and we sat and talked through kind of the psychology of what they're doing, and it was fascinating. At one point, we brought up that a group, we'll just say Adobe, was a stock that was being, selected inside this portfolio, and Adobe has made an acquisition recently, a $20 billion acquisition on another smaller entity, and there was a kind of a question mark as to whether or not that was going to be a good decision for Adobe. And this portfolio manager says, yeah, tomorrow morning I've got a phone call with the CEO of Adobe. We're going to talk through that. And Scott and I just thought, what kind of audience do you guys get access to be able to have, that kind of proximity to these individuals so that our clients can benefit from really knowing whether or not to make a certain decision about owning a stock? They're interviewing the CEOs of these organizations before they make these kind of decisions. That's a very powerful tool.
Absolutely. And it doesn't mean, again, that you won't have volatility in your portfolio. Even the best businesses in the world have volatile stock prices, right? But here's what it does mean. You won't get buried here, right? We're not waking up and saying, oh my gosh, this company went bankrupt. Okay. And remember, it's not just about it brand name. A year and a half ago, Hertz, the #1 car rental agency in the United States, filed for bankruptcy. And the headline says, oh, it's because of Uber. It's because of the pandemic. That's not true. The other car agencies made it. It was because they heaped debt on their balance sheet in an unbelievable and irresponsible manner. And it blew them up. And so you have to be really careful. Both of you are making a great point on that. Okay, so let me kind of close with this. So I've talked through kind of what our working thesis is. I mean, basically, the economy is slowing quickly, which is a good thing, because we do not think we're going into a deep recession. We think we're already in a recession, but that it's a technical recession. In other words, there's negative growth. But remember, we're coming off of an unbelievable path of growth. So we're slowing the growth down, which is technically a recession. We do not think we're going into a deep recession. The Fed's probably getting closer to being done hiking, and we're solving a lot of these supply chain inventory issues. Most of that is not a problem anymore, et cetera, et cetera. I don't want to be overly rosy. It is hard to eradicate sticky inflation. It's not an easy thing to do. So we have to go through this, and it doesn't happen overnight. We might bounce here in the stock market and have another leg down going into the end of the year. I don't know. But I do know we're starting to see interesting opportunities in the stock and bond market that we haven't seen in a few years. And this is a little, and when we come out the other side, you guys, our markets are going to be healthier than they were going in. I mean, we had people last year buying digital pictures of monkeys eating bananas for millions of dollars, right? The NFTs, right? We have people putting their whole life savings in crypto, just gambling, right?
Wait, Kurt, are you trying to tell me that my NFT of the monkey eating the banana isn't worth the $300,000 I paid for it?
I'm just not going to comment on that. But
all right.
But yeah, honestly, when that kind of stuff starts happening, you have to cool things off. And we've needed to do this. That's exactly what's been happening, And so you guys do this all the time. Those of you that are clients, of Paul and Scott and the rest of the guys there at the firm, you're in great hands. I mean, let me tell you, I know it seems sometimes self-serving in our industry to say, well, of course you need a financial advisor. And in a world where you have access to great information, it seems like, why can't I do this myself? Okay, I managed a large cap growth fund for 13 years, a multi-billion-dollar fund. That was my job. About 70% of the money that I have in my own retirement plan is managed by other money managers, because there's no way for anybody to be an expert in everything. And so it's awesome to have people riding shotgun that are less emotional about the money, because it's not their money, it's my money. They're thinking about the investments themselves, and then to be experts in niche areas, right? That I love that, right? And sometimes you pay a little money for that, and that's great. It's worth the exchange, you know? And so these game plan concepts about, you know, knowing what you own and why you own it, rebalancing maybe from time to time what you have, understanding, hey, I have to own a certain type of asset. They're going to be volatile from time to time. There might be other ways to do this, right? Alternatives to having everything just in good old-fashioned stocks and bonds. There's, you know, insurance structures that are really intriguing. There are alternative investments and things like this. So I'm going to shut up. I've probably totally overshot my welcome, Scott. Scott's going to be like, he can't come back. Like that's.
No, we appreciate that. Andrew can kill his screen share there, right? We actually really enjoy the dialogue, the back and forth, but more importantly, just having a perspective of why there really is information out there. There's really information out there that says, hey, we don't have to be convinced that this is the ledge and we're going to fall off of it. We don't have to be convinced that. And I think one thing that we do hear from time to time is this time it's going to be different, right? This time it's going to be different. And we hear that from time to time. And you know, when you look at the data and you look at history, you say, okay, well, why is this one data point different than the last 80 years worth of data? Unless it's the end of the world. And who was the line from your famous trader, Kurt?
Art Cashin, right, Kurt?
Art Cashin, when I worked on the floor in New York, when things got really sporty, he'd say, don't bet on the end of the world because it's only going to happen once and it won't matter then anyways.
Yeah.
He used to walk around and say this all the time to us.
Yeah. And I think that's a really good sentiment to end on, right? Don't bet on the end of the world because it's only going to happen once. And this probably isn't it.
Yeah, that's right.
Right.
That's
this
exactly
probably
right.
isn't it. And so we appreciate it. Scott, I don't know if you have any other questions you want to throw in before we wrap everything up.
I have to ask you this one, Kurt, because I think we field this one from time to time. And I spend a lot of time thinking about this myself. There's a lot happening on the global stage right now. We look at geopolitical risk, you know, Russia, Ukraine, China, Taiwan, et cetera. There's some risk of escalation, you know, with any of those types of conflicts. Those are inherently hard things to predict or plan for. Any guidance or thoughts that you might have on how to, you know, plan and prepare for those types of events?
You know, one of the things that has really surprised me in my career, maybe the most surprising in being in this business, is the things that actually, in the end, never end up mattering to the U.S. economy. It's stunning. I'm not a big tax guy. I would prefer to pay less taxes. Taxes historically have almost no correlation whatsoever on the economy or financial markets at all. None. Whether it's high, low, doesn't matter. I hate it. I'm not saying it's not important, but we're going to have a midterm election, right? That's one of them. Who's in the White House? Who's in Congress? No correlation. There's times where each party's been in there and the economy's been thriving, and times each party's been in there and it's been struggling, you know. The China and Russia, I hate to say this, because they are huge humanitarian stories in China and Russia. It's a complete non-issue. I mean, look, wheat and natural gas. What bigger stories are coming out of Eastern Ukraine right now than wheat and natural gas? Those markets are making new lows. I mean, if at any time it's going to disrupt markets, it's when we take Ukraine and Russia offline, then it's not mattering. Now, I'll give you a caveat. Putin gets desperate enough and lobs some kind of nuclear type of thing. You can't plan for that. Okay. The market's going to go down 3,000 points. We're all going to be pissed. We're going to wait, but everything will be fine. Like, it'll be fine, but it is going to be crazy, but almost no probability of it happening. The other one is if the Chinese set up that blockade around Taiwan. And when those ships go down there and they finally encircle that place and put it on a blockade, 60% of every semiconductor chip in the whole world comes out of Taiwan. That's a major problem. You think we had supply chain problems before? All hell's going to break loose. So, but those two things happening are so improbable because they hurt those people more. Those hurt the Russians and the Chinese even more than it hurts the rest of the world. The Chinese can't cut us off. 40% of Chinese GDP comes from the United States and Europe. I mean, they basically have to say, screw you and our own people, we're doing this. Like, it would be very, very painful. So yes, those things are always out there, but they're almost impossible to model. And very, very low probability of it happening. And by the way, we just met with a policy expert last week. You guys were in that meeting from DC. Gaming the midterms is almost impossible, as well as 2024. But the truth is, it doesn't matter. And most of Washington has become such a clown show. They're all enemies to what we're doing anyways, frankly, at this point. So again, control what we can control and invest in great assets, you know?
Yeah, and the way I often frame it to clients, if we do have a surprise event, you know, you articulate this well, Kurt, where you say the market sells first and asks questions later. You know, we would likely see a pretty visceral sell-off, and then there would be an evaluation of, hey, what is the actual impact to the real economy, and then calmer heads start to prevail.
Hey, I'll tell you what, somewhere I have it, I could dig it up. It's so fascinating. But there's a chart that I have that shows the one-day binary events of U.S. history that scare the hell out of you. Okay, Cuban Missile Crisis, 9/11. 9/11, for all intents and purposes, when it went down, we thought that we were under complete attack, like a world war started, right? The stock market freaked out for 72 hours and then was totally fine. So it's weird to disconnect those two because they are massive humanitarian and political stories. But at the end of the day, money finds its proper home. And that home is where you put in $1 and get $5 out. That's what business is. And money has a way of kind of slicing through the noise. And so headline risk is a real deal in the short term, but it almost, remember that chart I showed you? 75 years of earnings and stock prices traveling basically in conjunction with each other. So Scott, it really is. And it's mind-blowing that a lot of those things are such big stories, but probably won't really matter to the economy.
And along that chart, we could have plotted major world events every few years along that same chart.
Yeah. I remember I was on the New York Stock Exchange going into Y2K, December 31st, 1999. You know, we were expecting airplanes to fall out of the sky. You remember that, you know, there's so much to fear. And if we let it, we would never invest in anything good in our lives because there always is something to fear. Always. You know, my wife's worked for NBC News for 20 years. I mean, in their morning meeting every morning, all they want to talk about is negativity. That's all they want to discuss because that's what sells. That's what people watch, you know? And so you have to both be informed, but also only eye half open to a lot of that noise, you know?
Yeah, because if we act like my 7-year-old and just stare at the edge of the cliff, our feet aren't going to work and we're going to start feeling dizzy.
It's such a great story. That story is so good for teaching. I love it.
Yeah. We got to look ahead of us a couple of steps at a time and know there's a big, beautiful landmark up ahead.
Yeah. And by the way, you know, to your clients, if you're feeling stress about your investments in your retirement plan and whatnot, first of all, it's normal. Like I said, even the most hardened veterans that I worked with in New York have those same types of emotions. Just call. Let's talk about it. Like that's why we're here. And it might be, we need to make a change. You know, if you can't sleep at night look, this is an organic process. There's not just one right way to do this. We'll figure out the right way to get there, you know?
Yeah. No, it's great sentiment. Any other questions you want to throw in, Scott?
I think that's it.
Well, Kurt, we'll let you go. We know you're busy on the circuit, so we appreciate you taking some time with our clients today, and look forward to being able to visit with you again. And to all our clients on the call, we sure do appreciate you spending, what should have been a half hour turned into an hour, and not one single person dropped off. So we know it's fun to be together, and hopefully this is entertaining, but more importantly helpful as you guys kind of think through the future. And I'll echo Kurt's sentiment as we part. Just reach out to the team. You guys have a whole team of people here at Alliance Wealth Advisors. Reach out to us with questions, with concerns. Reach out to us if you're just having a hard time sleeping at night. And our goal is to guide you on that path safely, 1, 2, 3 steps at a time ahead, to make sure that you guys enjoy a safe retirement and a safe journey to get to that end goal and destination. So with that, we'll let you guys go. Till next time, thanks everybody.